Richard Staveley, fund manager at Gresham House Strategic. Are you ready to play the Edison bull or bear game?
I hope so.
Value over growth stocks.
Bull. Massive.
UK construction.
Bull.
The price of oil.
Bull.
FANG stocks.
Bear.
Convertible bonds.
Bull. Bull.
Airline stocks.
Bear.
Gold price.
Bull. Big bull.
ESG.
Bull.
Vaccine before the summer next year.
Bull.
The BBC.
Bear. Definitely.
UK consumer spending.
Bearish.
Trump over Biden.
It's Biden's going to win. Bear.
Huawei.
Huawei. Ooh. Bear.
Cannabis legalisation.
Bear.
Maro Itoje.
Oh, bull. Massive bull.
Yeah, he's great, isn't he? Are you a Saracens fan?
I'm not actually. I'm slightly suffering as a Tigers fan at the moment. But I do. It's been the scandal around Saracens pay and all the rest of it is amazing for the game. But Maro Itoje, what a leader, and I hope he when he clearly becomes England captain, I hope it's at the right time for him. I dread to think how many caps he's going to get in his career. It's just phenomenal.
Yeah. And just elaborating on some of your other answers, we had quite a few of them. Value over growth. Unsurprisingly, you're a bull on value stocks. Are you okay to elaborate more?
Yeah, sure. Look, it's obviously been very difficult for value investors for really quite a long time. It's been a long trend of underperformance of the value factor, quantitatively measured, versus growth factors, and because that trend's got reasonable, in fact, very strong momentum, it is difficult for people to sort of call time on it. And indeed, I would include myself as one of those that have been early to say this might have gone too far. Why has that trend happened? It's really linked to the manipulation of interest rates by central banks since the Great Financial Crisis, causing the discount rate to be artificially depressed, allowing a kind of re-rating of growth stocks. But I think that's the key here, really, at this stage in this trend, is that for many stocks that are growthy, they have experienced a huge re-rating. They've also experienced different levels of growth, but the actual free cash flow growth for many of these companies has massively lagged the re-rating growth. So at this stage, people really have to believe in a further significant re-rating to feel that trend's got significantly more legs to it, notwithstanding the fact that there will be some fantastic companies that can continue to grow well within that overall trend. So what I see it now is that it's accelerated in the last 18 months to, frankly, extreme levels. The performance difference between value and growth stocks is at extreme levels, the widest it's ever been. The valuation dispersion, the valuations you place on the differences between low and expensive stocks is also the most extreme it's been. So for those that are sort of fully locked and loaded and believe it's never going to change, I think there is a significant risk that just a move from being extreme to still being wide could actually have quite significant and impacts on a number of stocks now. And it could actually be quite fast. In fact, those sorts of movements often are quite fast and aggressive. I think for a more sustained move and calibration of portfolios to hold more in cheaper stocks than just the most expensive, fastest growing ones, it's going to require bond yields to start rising. And there's a range of scenarios which we could go through where that might start happening. I think the most interesting one on a medium-term basis is actually a return of inflation, which again I feel consensus is probably too complacent about. And if inflation does start to come through on a kind of 3 to 5 year basis, then bond yields probably are going up, and value stocks would perform much stronger relative to growth stocks during that phase. It just always, when I think about this trend and how long it's gone on, why really, it won't change. The Nasdaq has always been full of high growing businesses and a range of quality in there always, but some high quality businesses as well. The TMT bubble, which is now being met or exceeded by the current dispersion in value versus growth and performance of growth versus value stocks. From its peak to trough, which took 2 years of reporting, by the way, from anyone holding stocks through that period, it fell 73% on average. The average stock fell 73% in Nasdaq. Now, and at that time, the companies that were falling from there included some absolute nonsense, and also included some very good companies, which is what a lot of people are holding on to now, but are clearly very overvalued. Companies like Nokia and Cisco were perceived to be fantastic companies, dominant with fantastic outlooks, and we all know the rest is history. When I see things like this Snowflake IPO listing on nearly meant over 100 times sales, and Zoom, which we're now having this conversation on, but being valued more than IBM, and I don't even want to mention the dreaded T word of Tesla, really. I can't help but think that over the next few years, the opportunity is to actually build positions in companies like, guess what, Augean, RPS, Centaur Media, ULS Technology, Flowtech Fluid Power, who are all on really low multiples with significant profit growth and cash generation ahead of them.
Okay, great. And just on another answer you gave, you concluded that you were bullish on convertible bonds. I guess it depends on the company, but are you okay to elaborate on that? And do you like using convertibles?
Yeah, I think I said bullish because obviously I can't stand bonds at the moment. I mean, the concept of lending money to the UK government for 10 years and being paid, 0.5%, is just not palatable to me. But convertible bonds are a really interesting instrument. We utilize them within GHS where we can. It allows us to be in a different part of the capital structure and expose ourselves to equity upside, but also de-risk our exposure. Not all funds can do that. You can get decent coupons from them. So rather than what you get from government bonds, we're getting on ours 8%, which is a cash coupon. And then we've got the opportunity to convert that into the equity if we think that the business's prospects are continuing to evolve, and we can make money from that equity position. So they're decent. They're quite difficult to craft, it's fair to say. That's why there aren't huge amounts of them around there. But they are much easier to craft in this really exciting space below 100 million market cap than they are as you get higher up the market cap spectrum. So we've been in talks with a number of businesses actually in the last 12 months about potentially putting one in or not. So yeah.
Great. And if you would like to hear more thoughts from Richard and understand his investment approach at GHS, then please do listen to an interview I conducted last week. I will post a link in the description below. That just leaves me to say, Richard Staveley, thanks very much for playing.
Thank you very much, Elliott.